When you go to buy a business, chances are the seller is incorporating certain owner benefits into their SDE calculations. And if you were planning on using an SBA loan to finance this acquisition, you're going to need to know how SBA lenders view these addbacks. Hey, I'm Ray Drew, an actual SBA lender, and in this video, I'm going to show you how SBA underwriters view these addbacks, whether they will be considered in the loan calculations, and towards the end of this video, I'm going to go through some real-life examples of addbacks from CIMs that have recently come across my desk and share with you how SBA lenders would view them. Before a business owner decides to list their business for sale, they must determine how much it's worth. And the value is driven by a multiple of their seller's discretionary earnings, or SDE. And that often includes certain expenses that were to the benefit of the seller, but not necessarily carrying over to a new buyer. These owner benefits are considered addbacks, and therefore they're included in the seller's SDE calculations. The seller may also be including non-recurring expenses, like legal expenses having to do with a settled legal dispute, for example. Now, some business owners will be more aggressive with the addbacks than others, and that's usually a result of how far in advance they've been planning the sale and based on the advice of the business broker. Now, of course, small business owners want to write off as much as humanly possible to minimize their taxes, but small business owners with good advisors who reach them early enough will advise them not to do that. Because not only does it impact their ability to borrow, but it also impacts the buyer's ability to borrow to purchase the business. So here's how SBA lenders, like myself, view addbacks. When we analyze a business acquisition loan, we're viewing the last 3 years' tax returns plus the current year to date. And we're calculating the debt service coverage ratio. The DSCR compares the historic cash flow to the proposed debt. The SBA has a minimum DSCR of 1.15, which basically means for every dollar of debt repayment, the company generated $1.15 of cash flow. And that may work in some cases, but most lenders, and most buyers really, want more than that. For example, on a larger $3, $4, $5 million business acquisition, I may want 1.5 times debt service coverage. And ideally, you have that for the last 2 years, but sometimes you only have it for 1 year, and that's more common with businesses that have a higher growth rate. So what goes into the cash flow calculations? First, you start with EBITDA. That's earnings before interest, taxes, depreciation, and amortization. You can also add the seller's salary, but we also have to subtract the new buyer's salary. And then we add in the addbacks. And this is the part that's more of an art than a science. So how do SBA lenders view addbacks? Let's get into it. First of all, you need to determine if the addback is reasonable. Can we, with 100% certainty, confirm that this expense does not benefit the business? For example, the owner is expensing their Mercedes coupe and they own a tree trimming business. That's probably a safe addback. But advertising expense from a failed Google ad campaign, even though it wasn't profitable, it still may have benefited the business. That one is not valid. Once you've determined if the addback is valid, you have to pinpoint where it is exactly on the tax return. Ask the seller which expense line item on the tax return can this addback be found under. And this is important because sometimes the seller ties it to the P&L or even their bank statement. And that doesn't always mean it ends up on the tax return. And as SBA lenders, we have to tie everything back to the tax return. And if the expense wasn't actually expense in their taxes, you can't add it back, which should be obvious. Then you need the exact amount of the addback. So usually when I see a round number or the same exact number every single year, I can tell those are estimates. And they will likely be a little different when we go to document these addbacks, which is the final step, documenting. If we're gonna rely on addbacks in our cash flow analysis, we have to document them. The type of documentation that a lender will require is gonna include receipts, billing statements, and sometimes a letter from the seller's CPA. Now, let's face it, chasing down a bunch of documentation can be painful. But if the seller pushes back, just remind them that it's to their own benefit. Remember, for years they've been telling the IRS that these are business expenses. And now, when they go to sell the business, they're telling the buyer that, well, these aren't really necessary business expenses and they're not going to carry over, blah, blah, blah. And that's fine, but that's why we need to document it. Now, my approach is to document as little as possible to just achieve the adequate debt service coverage that we're looking for in our cash flow analysis. And just a heads up, the more buried that these expenses are, the harder that they're gonna be to document. For example, if it's buried into cost of goods sold, I'm probably not gonna even try. Now, like I said in the beginning of this video, I'm gonna go through a few add-backs from some of the recent CIMs and give you my take on whether or not I think they'd be valid for SBA underwriting. Example number 1 lists 8 add-backs and 5 of them just say personal, and one of them says personal 70%. And this is all the CIM says. I'm not saying that these are invalid, I just have no idea what they are. And if I saw something like this, I would go back to the broker who's listing the business and just ask, what are these and what are the specific amounts? Don't just say 70%. Because if you don't have the specific amount, chances are we can't document it anyway. Example number 2. As you can see, there are a whole bunch of add-backs, and I'm not quite sure what they all are, but when you have this many add-backs of small amounts, the documentation necessary to be able to rely on these expenses is going to be so cumbersome that it's not even worth it. And I actually did go back to the broker on this one and try to understand what some of these were, and there was things on there like Netflix subscriptions and groceries, and there's just no way I'm bringing my underwriter a box of 200 Netflix and grocery receipts and gas receipts to verify a few $1,000s. So hopefully this deal works without having to do that. Example 3, rent adjustment. This is really common when the seller owns the real estate, but the real estate isn't part of the sale. So the buyer is just buying the business, and then the seller is gonna become their landlord. So you would add back all the previous rent expense and then subtract what the new rent would be. And that's a way to normalize the rent expense for a new buyer. And sometimes this is an add back, but it could also be the opposite of an add back, a subtract back, if you will. Example number 4 is not an owner benefit, but it's a non-recurring expense. And in this case, the company redesigned their website, and it cost about $200,000 over 3 years. One thing to look out for is when non-recurring expenses happen every single year, it's sort of an oxymoron, right? A non-recurring expense that happens every single year. But in this case, it was an exception to the rule. Because it was such a large project, the expense did span across multiple years. And if you look back 4 and 5 years ago, you can see that the expense was 0. We just have to separate the one-time projects from the ongoing maintenance. So in this case, getting an invoice from the website developer that reflects a one-time project, and then we can account for the ongoing maintenance of the website, then adding back that one-time project should be a valid add back. So that's a few of the add backs that I've seen lately, and trust me, there's been some crazy ones over the year. Comment below with some of the head-turning add backs that you've seen, and if you're looking to buy a business and you have a question about a particular add back, drop that in the comments below and I'll do my best to answer it for you. So there you have it. If you found that video helpful and you want more insider tips from an actual SBA lender, I would invite you to click that subscribe button because I've got plenty more where that came from.